When banks locked their doors in 1933, millions of Americans discovered their money was worthless, so they invented a new currency. October 1929, the stock market collapsed. By 1933, 9,000 banks had failed across America. Depositors lost everything. There was no FDIC insurance, no safety net, just locked doors and empty vaults. What most people don't know is what happened next, not in the headlines, but in the towns themselves. Small-town merchants faced a crisis. Factories had stopped paying workers. Families couldn't buy food. The currency itself had vanished from circulation, not because it was destroyed, but because banks held it all, and banks weren't opening. A grocer in Pennsylvania couldn't sell milk. A coal operator in West Virginia couldn't pay miners. Both had goods, both had labor, neither had legal money. The solution emerged quietly. It wasn't new. Scrip had existed in America since the Revolutionary War, but now in the 1930s it returned. Local businesses, towns, and even counties began printing their own money, not currency backed by government, currency backed by goods, labor, and trust. Scrip took many forms. Some was issued by employers. A coal company would pay workers in scrip redeemable only at company stores. That's not what we're discussing here. Other scrip was issued by municipalities or merchant associations. That scrip could circulate. A baker accepted it. A landlord accepted it. It moved like money because in that moment it was money. Pottsville, Pennsylvania issued scrip. So did Scranton. In Michigan, towns printed notes stamped with dates. They were designed to expire, forcing people to spend them quickly and keep money circulating. This wasn't accidental. It was economic engineering born from desperation. Some scrip was backed by nothing but the issuer's promise. Others were backed by specific goods. A mining town might issue scrip backed by coal reserves. A grain cooperative might back scrip with stored wheat. The backing mattered because people needed to believe redemption was real. Without that belief, the scrip was paper. The federal government didn't ban it. Legally, states could issue scrip. Towns operated in a gray area. What mattered was whether the public trusted it. And they did, because the alternative was starvation. A piece of paper issued by your employer or your town was better than no paper at all. By 1933, scrip was everywhere. Estimates suggest between $200 and $400 million worth circulated at the peak. That's roughly $7 billion in today's dollars. It wasn't legal tender. It was survival currency. And it worked not perfectly, but well enough. The mechanics were simple. A merchant or town council would print notes. They'd set a face value, usually small denominations, 50 cents to $5. Workers would accept them as wages. Other merchants would accept them as payment. As long as the chain held, the scrip had value. But there were limits. Scrip could only circulate locally. A note from a Pennsylvania coal town was worthless in Ohio. And when the chain broke, when a merchant went bankrupt or refused redemption, the scrip holders lost. They had no recourse, no insurance, no government backing. The scrip era exposed something fundamental. Money isn't intrinsically valuable, it's a collective agreement. When banks failed, the collective agreement shattered, so communities rebuilt it, smaller, local, fragile. They were discovering what economists would later formalize: money is what people trust. By 1934, the scrip began to disappear. The federal government under Roosevelt introduced new programs, the CCC, the WPA. Direct government employment replaced barter. Banks slowly reopened. The FDIC was created in 1933, though it took time for confidence to return. Legal currency flowed back into circulation. But scrip didn't vanish entirely. During the 2008 financial crisis, some American towns considered reintroducing it. It never happened. Confidence in federal institutions held. Digital money, credit systems, and FDIC insurance made scrip unnecessary. Yet the memory remained proof that when formal systems fail, people improvise. The scrip era lasted roughly 3 years. It affected millions of lives, yet it's barely mentioned in standard histories. The Depression is taught as a story of breadlines and Hoovervilles. The scrip story is quieter, a footnote about how ordinary people solved an extraordinary problem. What scrip reveals is this: the monetary system isn't handed down from above, it's built from below. When institutions fail, people don't wait. They create what they need. They print money. They trade. They trust each other because the alternative is collapse. That lesson, forgotten for decades, still applies. The scrip money of the Great Depression was never meant to last. It was a bridge, a temporary solution that worked because people understood they were all in the same crisis together. Once that crisis passed, scrip faded. But the fact that it worked at all, that's what historians often miss. Today, scrip exists in different forms. Company towns still use variants. Some online communities use local currencies. But the conditions that created 1930s scrip, total institutional failure, haven't returned. Whether that's because systems are stronger or because we've simply been lucky remains an open question. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how money actually works, not how textbooks say it works, but how people use it when systems break, subscribe. Each week, we trace another forgotten financial story that shaped the world you live in. Subscribe to explore more forgotten financial systems that reveal how money really works. This video is for educational and informational purposes only and is not financial advice. Always do your own research.